When planning for retirement, one of the most important decisions you'll make is how to invest your savings. Two popular options are index funds and actively managed funds. Each has its pros and cons, and understanding the differences can help you decide which is best for your retirement strategy. What are index funds? Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to track the performance of a specific market index, such as the S&P 500 or the NASDAQ. They aim to replicate the returns of the index they follow, rather than trying to outperform it. Advantages of index funds. 1. Lower costs. Index funds typically have lower expense ratios because they are passively managed. This means fewer fees eating into your returns over time. 2. Consistency. Since they track an index funds provide steady, market average returns over the long term. 3. Diversification. Index funds often hold a broad range of stocks or bonds, reducing the risk associated with individual investments. 4. Simplicity. They are easy to understand and require less active management, making them ideal for long-term investors. Disadvantages of index funds. 1. No outperformance. Index funds aim to match the market, not beat it. If the market performs poorly, so will your investment. 2. Limited flexibility. Index funds are tied to their benchmark, so they can't adapt to changing market conditions. What are actively managed funds? Actively managed funds are mutual funds or ETFs where a professional fund manager makes decisions about how to allocate assets. The goal is to outperform the market or a specific benchmark. Advantages of active funds. 1. Potential for higher returns. Skilled fund managers can capitalize on market opportunities to deliver above-average returns. 2. Flexibility. Active funds can adapt to market conditions, shifting investments to avoid downturns or take advantage of growth sectors. 3. Professional management. Investors benefit from the expertise of fund managers who analyze markets and make strategic decisions. Disadvantages of active funds. 1. Higher costs. Active funds have higher expense ratios due to management fees, trading costs, and research expenses. These fees can significantly reduce your returns over time. 2. Inconsistent performance. Not all active funds outperform their benchmarks, and many underperform after accounting for fees. 3. Risk of poor decisions. Fund managers' decisions can lead to losses, especially if they misjudge market trends. Which is better for retirement? The choice between index funds and active funds depends on your financial goals, risk tolerance, and investment timeline. Why index funds are often recommended for retirement. Cost effectiveness. Lower fees mean more of your money stays invested and compounds over time, which is crucial for long-term growth. Predictability. Index funds provide consistent market average returns, which can help you plan for retirement with greater certainty. Simplicity. They require less oversight, making them a great option for investors who prefer a hands-off approach. When active funds might make sense. Seeking higher returns. If you're willing to take on more risk for the potential of higher returns, active funds could be worth considering. Market expertise. If you trust a fund manager's ability to outperform the market, active funds might align with your strategy. Niche investments. Active funds can be useful for targeting specific sectors or strategies that index funds don't cover. Key considerations for retirement investors. 1. Time horizon. If you're decades away from retirement, index funds' long-term growth potential and low costs make them a strong choice. If you're closer to retirement, you might consider a mix of both to balance growth and stability. 2. Risk tolerance. Index funds are generally less risky due to their diversification, while active funds can be more volatile. 3. Fees. Over time, high fees can significantly erode your retirement savings. Index funds' low costs make them a more efficient choice for many investors. Conclusion. For most retirement investors, index funds are the better choice due to their low costs, simplicity, and consistent performance. However, active funds can play a role in your portfolio if you're seeking higher returns or have specific investment goals. Ultimately, the best approach is to create a diversified portfolio that aligns with your retirement objectives, risk tolerance, and time horizon. Consulting a financial advisor can also help you make the right decision for your unique situation.